Welcome back, everyone, to Vox Markets. My name is Paul Hill, and by popular demand, I am delighted again to host the second edition of the Macro Investing Masterclass with three of the best investors in the city, namely James Bevan, Chief Investment Officer of CCLA, Colin, McLean, CIO and founder of SVM Asset Management, and super smart bond expert James Athey of AberdeenStandard. So welcome, gents.
Thanks, Paul. Good to be here.
Great to be with you.
Yeah, well, top marks last time. I mean, certainly your predictions came up just about universally correct when we put them back into January. But obviously, investors are sort of, sort of looking at the future more than obviously the past. So, Colin, I don't suppose you want to take up the challenge first of all and give us your sort of view, bird's eye view of the macroeconomic backdrop.
Yeah, certainly, Paul. Thanks. Looking forward to the discussion. We certainly found that some of the plays we were talking about at the start of the year, things like house builders and some of the inflation plays came off pretty well. Was surprising just how dull it's been in the growth stocks. I mean, we didn't really, quite expect the volatility, some of the sell-offs there. And that's despite the numbers coming through, but, that's been derated. So that's been a challenge there. But overall, markets have turned out to be sort of better than I hoped, and they've climbed this wall of worry about whether they're getting too frothy. We've had all the Bitcoin things and lots of other speculation, but a lot of the companies are delivering, and corporate earnings are being revised up pretty sharply in the areas we like.
Yeah. What about you, James B? I mean, I must admit, you sort of like talked about corporate earnings and the UK house builders and the banks and stuff, and they've just had an absolute fantastic rotation trade in the first sort of 5 months. How are you now sort of like pitching the sort of the investment horizon?
Well, I absolutely believe that corporate earnings will continue at pace. So for the S&P 500, we saw roughly $168 for calendar 2019. We saw a collapse to about $142 for end 2020. And I'm going to stick my neck out and say that we might see $200 in the current calendar year, maybe $215 next year.
Sorry, James, $200 in 2020.
$200 of S&P 500 earnings.
Now that is sticking your neck out, because I looked at the fact set and it was 169. So
well, absolutely. But what I would observe is that there is a strong following wind that analysts, I think, are being slow to upgrade. And if I am correct, fair value for the S&P 500 can finish the year somewhere between 4,300 points and 4,600 points. So I remain on the bull tack.
Wow. Yeah. I mean, I think if you're certainly sort of, that's blown past most of the Wall Street, and I would agree. I mean, I think when we looked at the sort of the S&P numbers last time in January, they've been lifted since then, and they're probably taking the sort of slow boat up the Nile to increase their estimates. What about you, James? In terms of the bond outlook? I mean, obviously you're a bit more I think the word you used, circumspect at the start of the year, but actually it's been a really strong rotation trade, and long duration assets have been pretty much mullered, unfortunately, and fixed income has had a tough time of it. Obviously it isn't going to go down too much, but what's your view on the bond market at the moment? Are we going to see it sort of like improving, or are we going to be very selective and pick your spots?
Yeah, I mean, right after we spoke last time, February was a pretty brutal month for bond markets, certainly in dollar block. It's been a bit less violent and volatile in European markets, just because they've been a bit more delayed in terms of vaccination, in terms of economic reopening. But really, since that massive move in February, bonds have roughly traded sideways. Certainly treasuries have sort of traded in a sideways range. There's a lot of consolidation. A lot of investors moved from one side of the boat, to the other rather rapidly, and obviously positioning does weigh there. So, I mean, we're going to get into the macro discussion now, but inflation is going to play a massive role in what happens to bonds. But obviously, central bank reactions to that inflation, possibly an even bigger impact on what happens to the bond market. So I'm minded to think that we've seen, for now, the bulk of the move in the treasury market. I think it's harder yards from here. And one of the reasons is one of the ones you've already alluded to there, which is duration sensitive bond proxy and particularly growth stocks really do not like the headwinds which come from higher yields. And if we start pricing a more hawkish central bank, I don't think many risk markets will particularly enjoy that prospect.
So just on the inflation front then, James, I mean, that's the $64 million question, I think. Is it transitory, which is the central bank view sort of like held for across the world, or is it actually, you know, sort of like going to be more sort of sticky and long lasting? I mean, everything is going up in price. And I have never in my lifetime seen a booming mid-digit growing GDP Western economies to have 2 to 2.5% inflation. It just doesn't. I've just never seen it. I'm just skeptical of the central bankers. What's your view, James?
Yeah, well, that's a good start, Paul. I mean, my gut reaction says just state the opposite to the central bankers, because to be honest, they've been so wrong for so long on inflation. I think the economic theories, macroeconomic theories, which underlie, you know, the policy regime that we've been in for 30 years really are substandard, insufficient, incomplete understandings. And so, you know, my gut reaction is to just oppose the central bankers. I have to be honest, I find myself somewhat agreeing with them at the moment, though, because ultimately the way in which you get to the 60s, 70s, 80s style of scenario really does require wages to be rising as fast as prices are rising. If prices rise faster than wages, then that's a hit to real incomes. That's a hit to the ability of consumers to consume, seeing their earnings power actually being eroded by prices. And I'm just not sure, given the underlying health of economies, the state of economies, the composition of labour markets is definitely vastly different. The lack of unionisation, there are lots of things under the hood which are not cyclical in nature, which I don't think are really vastly different today to where they were pre-pandemic. And I think ultimately those forces will be the deciding forces in terms of the inflation regime. But I will be 100% honest, and I'd love to hear more central bankers being as honest. I have no idea. The answer is it's a very, very uncertain macro environment. We're engaging in a policy experiment real time, the likes of which has never occurred in the aftermath of an extended period of experimental policy, and then obviously a dramatic economic hit in the form of a pandemic and government-induced lockdowns. There's an awful lot going on there. And so I don't think it's too difficult to make the case for either an inflationary or deflationary outcome. I just err on the side of transitory for now.
Yeah, well, I mean, to be perfectly honest, rather than actual central bankers, I prefer to get sort of apolitical sort of like views or objective views. So James B, what's your view on inflation? I mean, this whole argument in terms of salaries and wage inflation, yes, there might not be pricing power from employees, but frankly, if governments are going to get into power again, they're going to have to lift minimum wages. In fact, companies are. You've seen it with Amazon, paying their staff $30. But so I think regardless of pricing power of labour forces, minimum wages governments is going up. I mean, what's your view, James B?
Well, I absolutely agree that minimum wages will rise, but I'd like to cut this into two timeframes. I think that in the near term, it is absolutely clear that inflation is rising. We will therefore see the consumer price index in the UK north of 2%. We will likely see the retail price index north of 3%. And we can trace the food price and energy cost inflation running through the system. That means that sort of outlook, it looks to me relatively assured. Further out, I still think that we are going to be handling deteriorating demographics, aging populations, which is inherently disinflationary. We still have disruptive technologies, we have high levels of indebtedness, and we have globalization to the fore. And those factors, I think, will constrain inflation in due course and address the supply and demand imbalance that we are observing at the moment. Of course, what we have is a huge surge in demand, and supply will take time to catch up, and hence a squeeze in prices across a range of activities and commodities. Even cement, I see we're looking at a 15% hike in prices because of a relative absence of supply relative to current demand. Having said all that, I do think that the wage issue is important. I'm going to put a 2/3 probability on inflation coming back down next year. and a 1/3 probability that we get a deterioration towards the sorts of conditions that we saw in the 1970s. To put that case forward, it is the case that wages are rising in the United States. Mr. Biden is calling for a minimum wage of $15. Kamala Harris is now fronting a group of people trying to reunionize the states where only 6% of employees in the private sector are currently union members. So we do have the ingredients for potential wage inflation. The get out of jail card, which is why ultimately I side with the inflation being transitory perspective, is rising productivity. And there are clear signs of improving capital expenditure leading to rising productivity, which I think will pay for higher wages.
Right. Well, CapEx, that was certainly, Colin, that was certainly something you raised as being the last piece in the jigsaw for the economic sort of like booster for corporates, etc. Are you seeing sort of CapEx come back? I mean, certainly it's been in IT. There's lots of spend in terms of software and cloud and stuff like that. But what about factories, sort of hard assets? I mean, are they increasing, reshoring and increasing capacity?
I think we are going to see that. So I'm not so far from James Bevan's position on this. I think some of this is going to be transitory. We're also, even on IT spend, which has been about resilience and as much as productivity, I think cyber risk, cyber security is quite a big issue. And that's going to spur more spend there as well. So I think we are, perhaps even also from this G7 agreement on tax, there's going to be a lot more encouragement to spend corporate cash if it is going to be taxed a bit more. So I do see more capex, and I think a certain element of inflation just now is transitory. Although I would expect some sticking points, like chips and so on, to maybe still be quite tight through next year.
You mean silicon chips, I guess?
Yes, yes, indeed. I think it might be interesting, and it'd be interesting to see what James A thinks. But maybe the Bank of England might be forced to tighten before the Fed does. I think the UK is a bit near overheating. It's coming out of the pandemic, strongly. We're also hitting more Brexit bottlenecks, and it just in the very short term does look as if there's a bit more overheating pressure in the UK.
The ball's in your court, James. And what is the answer? Will the Bank of England move before the Fed starts tapering?
I don't know, to be honest. I don't think the Bank of England knows. There's definitely a division on the MPC. The internals and the externals are expressing a very different opinion about exactly how much of, how big a mismatch there is between supply and demand. It's really interesting. If you look at the Bank of England's estimations for the output gap, really, it disagrees with the notion that James B just raised about this excess of demand relative to supply. What their estimate has shown is that supply and demand were both hurt by pandemic and lockdown, and supply and demand have both recovered commensurately since then. And so actually the output gap hasn't moved a huge amount. Now, that's suggestive that a monetary response wasn't necessarily required, at least not a huge one. But obviously they've gone ahead and provided one anyway. But I think the Bank of England is openly discussing various mechanics in terms of how they engage in the policy tightening. And if they were to, for example, begin selling down their balance sheet before raising interest rates, that might be more of a market event and less of an economy event. I think that would very much allow them potentially the cover to begin that process before the Fed was actually tightening. So I wouldn't discount it at all. I don't think necessarily the UK is closer to overheating than the US. I think the US fiscal response is also absolutely huge, and the potential for retardation of the labour supply in the US because of these huge stimulus checks, and therefore create wage and price pressures earlier than would otherwise have estimated to be the case, is definitely real. And if the Fed were to start to accept that view somewhat, I think they would be hiking a lot earlier than they currently expect. So again, huge amounts of uncertainty. I wouldn't discount the Bank of England beginning the tightening process before the Fed. But I think there are risks in either direction, because we've got this very short-term period where there are huge forces colliding, and we could see some really huge inflation numbers. but to some degree that may well be sucking forward inflationary pressures that we were expecting to happen later in the year. And so you could just get a sort of inverted V shape for the inflation profile, and central banks, if they could, hold their mettle through that period, would then find themselves not really under pressure to tighten at all. So that's a cop out of an answer. I don't have a strong answer for sequencing between those two major central banks. I think we're on that journey now. I think both central banks are heading in a hawkish direction. Sorry,
James, let me tie you down on a particular point. You talk about the determination that it will be appropriate for central banks at some point to begin to sell down their book and to reverse quantitative easing. Where do you then see long bond yields in the US and the UK settling?
I mean, if the Fed, we've got some experience recently with the Fed attempting that process in 2018, and it obviously ended with a complete capitulation of the central bank, such that having stated that that policy would be on quote unquote autopilot, Jerome Powell's recent comments on the balance sheet essentially suggest that there is no environment in which they would be actively selling down assets, which is a complete 180. If the Fed and the Bank of England were to be selling down assets together, that could be incredibly disruptive for the bond market. But I would again openly query whether which force would dominate. Would it be the upward pressure on bond yields coming from active selling of duration, or would that actually be a very destabilizing event for risk assets, such that you end up with a flight to safety for bonds, and bond yields are, sell off a short distance or even rally? The evidence from 2018 suggests...
I'm trying to get you to come off the fence and give me an answer as to where you think the long bond yield will settle in the US and the UK in the event that central banks stop quantitative easing.
The natural rate, I think we're looking at.
Yeah, I mean, good grief. There's so much to say. Where would they settle? Gilt yields, I can't understand what they're doing at 80 basis points in this environment. If the Bank of England would start actively selling them, they could hit 150 in very short order, I would estimate. I think treasuries have priced more of that process already at this juncture. Very similar setup for the UK and the US in a lot of ways, and yet the steepness of the US yield curve is far greater, even though the UK is a more inflationary economy. So I don't think that the taper of US assets purchases is going to be as big a destabilizing market event.
When will that happen, James?
If they were to say they were selling assets, all bets are off. You could see treasury yields really fall out of bed. Something north of 2.5 wouldn't be unreasonable. So my base case at the moment is, and this is pretty consensus, so I'm not saying anything particularly insightful or interesting here, a signal at Jackson Hole, an announcement at the September meeting or possibly in October for commencement of a taper, either in December or in January. That process would probably take 12 months. It would probably be a 12-month taper, so fairly steady. And I think at the moment, the risks are to the market pricing earlier hikes than the Fed is currently estimating rather than later.
And where do you think the 10-year Treasury is going to be at the end of the year and the end of, say, 2023?
So again, this goes back to my view about whether or not all of these tightenings are really bad for the long end. To me, the 5-year point is a much more interesting conversation. Real yields in the US 5-year Treasury are where I think you're going to see the real action, because we've had a front running of this process to a large degree via the steepening of the yield curve, which actually reflects a lot of term premium uncertainty, inflation premium. Once the Fed begins that discussion around tightening, they are burnishing their credentials on inflation fighting, stability of prices. I think that becomes a yield curve flattener very, very quickly. Selling 5 years, 5-year nominals, 5-year real yields in general here still feels like quite an attractive asymmetry. Whereas if you look at how the long end has behaved, it increasingly is finding support. We know there is global structural demand for duration. The US looks cheap and attractive on a hedged and unhedged basis for global investors. And of course, as we've already briefly discussed, a lot of the rotation going on under the hood in equity markets is just disturbing risk markets sufficiently to occasionally find a flight to quality bid in the long end of the Treasury market. Once we get into the proper taper, the proper tightening discussion, I think that becomes more powerful. And so I expect to see higher 5-year yields, higher real yields, a higher dollar. That becomes a bit of a headwind for risk assets. I quite like the yield curve flattener. That will be one of the topics that we do discuss is top trade recommendations. Well, my first one is a yield curve flattener in the US. I think you capture a heck of a lot of the potential probability distribution in that position. Right.
Just to fill in the blanks, I know Moody's yesterday came out that they reckon it's going to be 2% 10-year treasury at the end of this year and 3% by 2023. In terms of the currencies, Colin, any view on pound? It's had a bit of a sort of, again, continued its sort of strength. I mean, obviously that's going to play into UK exporters, and it's also going to be playing into, well, contrary, obviously, is the dollar weakness story as well.
Yes, and if I picked James up correctly there, I'm maybe less sure that the dollar will recover from here. I certainly think on cable and the pound versus dollar here, I think there's scope for the pound to move up a good deal more, and I think that's going to be quite a headwind for international earnings, viewed from the UK. So it encourages me very much to domestic earners, the traditional mid-cap area for the UK.
And what about you, James B? I mean, you mentioned sort of like you've also got quite an international portfolio, global on the mega cap side. What's your positioning on the stock sort of like side at the moment?
Well, when I think about sectors, and by way of background, I do think that we will see a US 10-year yield at 2% by the end of the current year, and probably 2.5% by the middle of next year. I don't think that seriously damages the long-term case for growth and quality, because I do think that growth and inflation will slow thereafter. But for now, I think that the big bets ought to be in discretionary rather than staples. I think that industrials, materials, and energy all look well placed. And I'm keen on healthcare and financials. I mean, when I look at the opportunity that JP Morgan as a global bank has to make money in the context of cost efficiencies and in its opportunity to lend, I see a company that is woefully mispriced and way too cheap. I equally think that it's right to be relatively well weighted towards technology and communication services, and indeed internet retail. And therefore, the only underweights I have within the global equity context are real estate investment trusts, where I think too much of the good news is now fully embedded in prices. Staples, because they had their day in the sun and are now past it, and utilities, precisely because I think bond yields are going up. And in an environment of accelerating economic growth, those sorts of assets get left behind.
And so the utilities and the sort of consumer staples and the REITs, I'm guessing they've just been bid up because they're bond proxies, are they, by the fixed income guys? They're piled in, and therefore pricing is not that attractive for the equity side. Is that right?
When I look at the trade-off between growth and price, I see relatively low growth and relatively rich price, and precisely therefore I don't want to be there.
Yeah, good. No, just on the banks. I mean, it's been a home run, obviously, on JP Morgan. What about the UK banks, James B? I mean, is it? I saw you do actually own some Lloyds. What about NatWest as well? I mean, are they less attractive than the US guys because the economy in the US is absolutely ripping?
In a global context, I absolutely believe that the top US banks and some of the Asian banks, HDFC in India, for example, I think looks at an excellent long-term opportunity. And in that global context, I do think that the bulk of British banks are second division.
Okay. And then, James A., last time, you talked about yield steepening plays, and now you're talking about yield flattening plays. Can you just talk through that? I mean, first of all, what types of assets do you buy in a yield steepening? And then likewise, what's the logic now going to the yield flattening play?
Yeah, I mean, moving. I hope you didn't come to me, by the way, because James had just said second division, Paul, but that's another matter.
No, I'm second division, don't worry.
Absolutely not.
But yeah, that's the normal course of events in an interest rate cycle. Is that, let's say you start at the sort of lows of the recession or depression, and you start with low yields and a flat yield curve, and then as investor confidence returns, expectations rise about the future relative to today, you get a steepening of the yield curve reflecting essentially future interest rate changes in a hawkish direction because the economy is improving. And then as that reality becomes real, you find that the front end will then begin to move because there are imminent policy changes from the central bank, and that flattens the yield curve. That tends to slow the economy. And then as you tip over into recession, you get a bull steepening as short ends fall, reflecting the fact that policymakers are going to have to cut rates to re-stimulate the economy. And obviously, if that's not successful, the yield curve flattens at a low level again. That just happens in rotation. And so what we've had here really is a lot of interest rate cycle compressed into a very short period of time. We've had the journey from where we were at the end of 2019 to where we are today has been incredible, to say the least. We find ourselves pretty much shortcutting back towards late cycle conditions. I'm not saying we're quite there in terms of late cycle, but we're getting there, and we're getting there fast because fiscal policy has played a much more active role than happened post-crisis.
But do you really?
Than people could expect.
So you think the central banks will start increasing short-term interest rate? I mean, I just can't see that. They're all indicating such that, like Janet Yellen, even yesterday, the Treasury Secretary, she's not in the Fed, but she was basically saying she's going to run the economy hot. Jerome Powell said that the same. The Bank of England have indicated the same. It looks as though they're going to nail short-term interest rates to zero for a long time and let inflation run. And therefore, if anything, aren't you going to get more steepening?
First and foremost, I mean, doing what central banks think, following the guidance of central banks has not been a successful investment strategy. Again, Jerome Powell claimed in October 2018 that balance sheet unwind was on autopilot. By early 2019, yes. They were essentially cutting rates again. You know, part of the problem they have which is inherent in monetary policy, but made worse by the modern view of central bank communication, is that policy operates with a lag, and policymakers try to smooth the reaction to their policy changes by communicating in advance. What that means is they have to be thinking 1 or 2 years ahead, but doing so relies on them making forecasts about how the economy is going to turn out. And they're not very good at that. So they've now tried to institute a new framework. Certainly the Fed very much codified a new framework where they will only respond to realized changes in the economy, not based on forecasts, but they will continue to communicate in advance. That is a paradox. They cannot do both. That is absolutely impossible for them to do both. And so I think there is a sort of deal with the devil whereby they're quite happy to give the impression today of incredible dovishness forever and a day in order to allow the conditions to emerge, which will create this hot economy, if you like, which will get them to their goals more quickly. But I do not believe that as they approach those goals, they will continue to sit idly by and allow incredibly hot inflationary conditions to persist for very long or as long as they're suggesting. Moreover, I'm an investor and I'm not as worried about what the Fed will do. I'm worried about what the market thinks the Fed will do. And I do not believe that as we sit here today, the market truly believes that the Federal Reserve is going to sit idly by and allow inflation to get out of control. And so I think the market will test the Fed, not in the 2-year Treasury, not in the very front end, but if you look at the Eurodollar strip, which is a contract which is based off LIBOR expectations, that has been steepening. There continue to be popular trades positioning for a more hawkish Fed. And as I say, if you look at the US 5s 30s yield curve, 5-year Treasuries versus 30-year Treasuries, we see that flattening in both bear and bull markets recently, telling me again that the market is not fully believing of this overtly dovish message.
So what you're saying, it's going to flatten between the 5 and the 30-year rather than actually in central banks increasing short-term interest rates by a quarter point.
I'm not calling for the Fed to hike anytime.
Just going to say, I was getting a bit confused on that. I was thinking. So
but sooner than they expect. To go back to another point you made about which assets, I mean, James is. It sounds like both chaps have probably been in this trade. Financials is a very obvious one. Banks, financial intermediaries, those engaging in maturity transformation, borrowing short, lending long. That's a much more profitable business when there is steepness in the yield curve, when longer dated yields are significantly higher than shorter dated yields. So financials is a classic to position for that. On the flip side, growth stocks, which are more heavily influenced by the discount rate used to present value their future earnings. If yields go up, that tends to not be a great place to be. That's a very simple sort of strategy for how one might position for higher yields in a steeper curve, or conversely, lower yields in a flatter curve.
Yeah. What, Colin, in terms of the sort of the middle small caps, etc. What do you? I mean, obviously we talked about UK house build. I think James B raised it last time, and you sort of like agreed with him. That what's your view on the UK house build? They've actually come back. They came back really strongly, like the financials, probably up 50% or so in the last 5 months, and they're not that cheap now. What's your view about the UK house builders going forward?
We still like them, still adding to ones like Taylor Wimpey, Persimmon. So I think there's still opportunity there. I think the UK is emerging quite strongly and with huge pent up demand. So we're still quite encouraged by that. We're buying a lot more small and mid caps, maybe in very almost special situations, ones like Genus and Kainos. You know, it's really very micro led. You know, bottom up, company meeting led, and we just believe some have got good strategies and pretty good moats around their individual niches.
Yeah. And James B, in terms of the sort of different sectors, you mentioned sort of like the medical side, diagnostics. What about the big pharma? Because there does seem to be quite a lot of value there in terms of, I don't know, something like Merck or Gilead or Astra or people like that. Or is that a place that is a bit of a crowded trade in oncology?
No, I absolutely agree that that's an area that is likely to prosper. I mean, if you said to me, where within the big cap space am I mistrustful relative to the street, it's clearly on traditional oil and gas energy. We know that the oil price has had a pop up, but when I look at the case from The Hague for Shell, I absolutely see a combination of legislation and regulation, litigation and customer action, clearly identifying that oil and gas companies are not only frying the planet, but also they are likely to burn a lot of damage through investment portfolios. So that's an area where I absolutely will not be participating and stand out relative to the street in that regard.
Yeah, because the oil and gas has had a bit of a rip-roaring trade, hasn't it, in the first sort of like 6 months, certainly on the...
and I've not been there. I've been in the sustainable and renewable energies, and I am convinced that oil and gas is a dying industry, and for both financial and extra financial reasons, it's a trade I just won't participate within.
Yeah. And Colin, I know you're well positioned in the hydrogen side with your Ceres Power and your ITM side of it. Now that's quite interesting because they've come off quite a lot now, so they're getting a bit more sort of in the value trade. I mean, is there a possibility that some of these big oil and gas integrated guys buy these hydrogen plays to try and green themselves up?
I doubt that with those names. We're still, we have both Keen and Ceres. I think they are basing out all that they're implementing. Still looks good. The ratings were high, so there's an element of de-rating there. But I think there's still huge potential really in all this alternative energy. And I agree with James. In fact, despite the oil price just of late, oil majors certainly have not been a place to be just over the last 2 or 3 months. I don't think it's been quite as clearly translated into oil and gas stocks. So we still think that alternative energy, some of the other wind farm companies and so on are the place to be for the future. It's going to be quite a long sustainability and climate change, quite a long running issue, and we've got a big conference coming up. In fact, in Scotland, we've got a big conference coming up later this year, September.
Yeah, and there's one turnaround stock which has come off a lot as well since we last spoke. And I know we didn't mention it, but I think you own is actually quite a controversial one. Blue Prism, which I think that does sort of like software robotic automation, but is a leader in this space. And it's sort of like trading on about less than 5 times sales compared to one of its recently listed competitors, which is on over 30 times sales. And there seems to be a huge disconnect. I mean, what's your view on sort of like that's tech software? Because that'll play into James B's the hypothesis in terms of increasing productivity.
We do like that. We've got exposure to a number of companies, at a much bigger size than the FTSE. Aveva, that's the one spelt with an E and not an I.
The software tech sort of build sort of business.
Yeah. These ones are very much about productivity in traditional sectors. I think that's going to be an area of increasing spend and quite a big issue. So we've got that one.
Okay, well, let's go through the table in sort of top sort of ideas for the next 6 months. I think we've bounced out a good sort of like macro perspective and sort of sectors. James A, I don't know if you want to kick us off. So you say it was yield, Steve. I think you went for US Treasuries and Australian bonds last time. Where are you heading for at the moment? Is it similar sort of plays or?
Yeah, I mean that call would have looked horrible a month after we had our last call, because February was absolutely brutal. Both markets again have shown a very similar consolidation pattern, so we like both of those markets relative to laggards in the vaccination reopening process. So shorting European government bonds, shorting gilts versus the likes of Australia and the US, definitely positions we still like here. As I say, I think the yield curve flattener in the US is the kind of trade that one can hold for a reasonable period around this transition from the on-hold dovish policy regime to one which is beginning to tighten.
How would you play that, James A? I mean, do you basically, if you're going for a flattening, I mean, presumably where it currently lies from a relatively a steeper curve, are you shorting the 30-year and buying the 10-year or buying the 5-year? Is that how you play it?
So selling the 5-year, buying the 30-year would be my preferred expression at the moment. So selling 5-year bonds.
Oh, okay, yes, because it's
selling 5-year. Yeah, prices and yields. That relationship, obviously, selling the 5-year bond, hoping the price will fall, the yield will rise there relative to 30 years. So that process kind of, as we get closer and closer to lift off for rates, if you like, you start to see 10s, 30s flattening first, then 7s, 30s, and 5s, 30s. So I just think we're around that time where the 5-year is asymmetrically biased towards yield increases in the future. Again, just reflecting a lot of the macro forces that we've talked about. So yeah, and short real yields in the US as well. A similar trade for a similar environment. Essentially, real yields are very low. The Fed has done a good job of suppressing them. We've seen 30-year real yields rising, 10 years to a lesser degree. Over the coming months, I think we'll see that movement higher in real yields starting to affect the 5-year a bit more. So selling 5 to 10-year US real yields is an attractive way of positioning for a continual improvement in the US economic environment. Higher inflation prints, higher job creation, stronger growth. All of those things will increasingly cause the market to push real yields higher, reflecting the fact that ultimately policy is asymmetric from here. It's not going to be eased. It will be tightened at some point.
And what do you sell there? You're selling tips and you're selling linkers in the UK.
Exactly right.
So what are you buying then? Are you buying anything? You're staying in cash.
Well, to be honest, as a bond investor, this is something that you sort of have to deal with, is that correlation between global bond markets is incredibly high. You do not get the sort of environment often where US yields are rising and yields elsewhere are falling, for example. So you tend to be bullish duration or bearish duration. So what am I buying? Again, it's the US, it's Australia, those markets which have already repriced higher. I'm buying longer tenors in those markets, again, reflecting the fact that structural forces are still going to curtail the extent to which the central bank can hike, are going to curtail long-term inflationary pressures, and therefore moving forward from this point, I think shorter yields and real yields are more vulnerable than longer dated nominal yields.
Yeah. What about yourself, James B? What are you sort of like been buying or looking to buy? And obviously, well, you've talked about the underweights, but it's sort of like, presumably you're staying with your top quality growing stocks that you talked about before.
Absolutely correct. So I already have big weightings in the better technology companies at the right price. And the other areas which I think are perhaps relatively new are some of the discretionary spend companies. I would view Kering, company that owns Gucci, as well priced at current levels. I think some of the industrials companies that Schindler, the lift manufacturer, looks well placed. And as we've discussed, some of the healthcare companies, as COVID ends, we will go back to elective surgery. So the diagnostic companies, the hip replacement parts, the kidney dialysis companies, all, I think, very well placed. And finally, on the industrials, I do think that where people are able to do things well, it's perfectly possible to make appropriate money. The only industrials area where I would say that I am still absolutely not persuaded is automobiles. I can see that we're going to be car manufacturers making money. I just can't tell which one, and therefore for me, I'm not going to play the game.
Yeah, I think people like GM and Ford have done very well this year. They've sort of bounded, haven't they, on their EV side, but they were extremely, well, I think they were considered low value, but you're right, there's still probably excess capacity going forward in that whole market. What about you, Colin? Where's your sort of your top plays in the mid and small cap sector?
I think we're tending towards it's been a great run in small cap overall, more towards the top end of mid, and there's still opportunities in some of the FTSE and bigger companies. So we've generally been adding to stocks like CRH, Smurfit Kappa, St Thomas. So Smurfit is an example where pricing's picking up, and it's also generally in paper use, getting some benefit from switch from plastic packaging into that. So
what about AO World? You talked about that last time, and that's sort of like coming gain into value territory.
Yes, we still got some of that. We did cut back, I think, perhaps indicating our move back into more from the high street, from online. We switched quite a bit of our Ocado earlier this year into Marks and Spencer. So
into Marks and Spencers. Well, that is an interesting play. What was the thesis behind that one? Because it was beaten up.
It's beaten up. There's a lot of moving parts, and obviously a lot of debt there, and lease problems and so on as well. But there's freehold, and I think that the numbers that are coming through are better now, showing there could be some value in non-food. Certainly in the food, some of the remodeling that they've done, looks pretty good in the new stores, and there's within those moving parts quite a lot of potential for value accretion in food and with the Ocado venture. So it probably illustrates our sort of move from the more tech end in Ocado to the sort of real world, high street, presence of Marks and Spencer.
Yeah, well, they should benefit at least by people moving back into the office buying more suits, I guess, and ties. But I'm not convinced anyway. We'll wait and see on that one. Just top level sort of risks, James. You talked about dollar weaknesses, continued dollar weakness going forward. What could surprise the market? I mean, I look at inflation, and the market has taken sort of like, the sort of the Fed and the central banks hook, line and sinker in terms of transitory. If that doesn't happen to be transitory, that would just be really disturbing. But what's sort of like your most likely surprises? Not mine, obviously.
Yeah, I think the market's pretty split on transitory. I'd argue that probably half the market believes it will be transitory, and possibly half thinks less so. And that's an important outcome for the dollar, the extent to which the Fed responds or doesn't respond. If inflation continues to print 3 and 4%, and the Fed doubles down on its dovish message, pushes further away from policy tightening, the dollar will continue to weaken, and that will drive commodity prices higher. That will drive the cyclical sides of risk markets, and that will be I would imagine, a very bullish environment for a period. There are risks in both directions, Paul. Again, I'm not known for sitting on the fence, so I'm sort of find myself, yeah, exactly. James has raised his eyebrows there because it feels like I've couched everything in ifs, buts, and maybes. I sound like an economist. But this is an incredibly uncertain macro environment. So I think there are risks in either direction. I think there are risks that economies overheat. There are risks that the economy overheats and the central bank does respond. There are risks that it overheats and the central bank doesn't respond. Equally, underneath all of this, you want a high conviction call. Nothing that was plaguing our global economy in 2018, 2019 that was causing the central bank to reverse course and cut rates, and that had meant that no other central banks in developed space had even got round to tightening, with the exception of a couple from the Bank of England. None of the underlying health issues economically which led us there have been dealt with by what has happened from policymakers in the last 12 months. In actual fact, and it's something that James mentioned himself, probably one of the bigger causes to the underlying economic malaise, the sheer quantity of debt and the over-reliance on debt to generate growth, has merely got bigger and bigger and bigger. And that's not an imminent danger, but that is a sword of Damocles which hangs over us all. The fact that this debt needs servicing, it needs paying back, it needs rolling, and it's just getting simply larger and larger. And the growth response to that debt growth is getting smaller and smaller. It's taking more and more debt to generate less and less growth. That's not healthy. That's not taking us anywhere good. So ultimately, long term, I am a bond bull, because these secular forces will be the dominant force in the end. in the short term, investor psychology and the madness of central banks, and now the profligacy of Western governments, is creating this perfect storm, pushing us in a cyclical direction. That cannot and will not last, but obviously I'm no soothsayer, so I don't quite know where it ends.
Yeah,
So
you raise
being tactical is helpful in this environment.
Yeah, you raise a very good point, because when we were talking in January, I was more uncertain, and you were sort of like, greater clarity, and now you're more uncertain about the environment, and I've got sort of greater clarity in terms of what I think. But what about you, James B? Just finally, in terms of sort of risks and where you think is the environment more sort of, is it similar sort of level of uncertainty and things could move in either direction, or is the sort of like a technical standard deviation smaller now than it was in January?
Well, I think the two big risks are, first, with regard to the United States, that Mr. Biden is not actually able to push through the fiscal plans that he has announced. There's a broad expectation that he has sufficient authority and political power to drive his fiscal agenda. Actually, the numbers don't stack that way at all, and I think there is a reasonable risk that he is unable to spend the money, and therefore the US economy doesn't get the push that everybody is expecting. I think the second risk is China. There is a broad expectation that China's economy has recovered well. Actually, if you lift the lid on the state of finances of some of the state-owned enterprises and the shifting tide with regard to the Chinese Communist Party's attitude towards state-owned enterprises, I don't think I would be at all surprised if we saw some quite significant defaults and a big shift in the Western attitudes towards business in China.
Wow, yeah, we've been talking about China for years, but I mean, that'll be, if you had a default, a significant default, that would be negative for people like HSBC and Standard Charter, I guess, on those banks in the UK. Would that be correct, James B?
Well, and French banks, which have funneled a lot of cheap US dollars achieved through quantitative easing into China. But more broadly, China has been a deeply important part of the capital market system for well over a decade. After all, they helped solve the market's problems after the global financial crisis. I do think that we're going to run out of tarmac on that particular story. And a risk is that China materially underdelivers against consensus expectations.
Wow. What about you, Colin? As in, like, just I know you talked about taxes, and you given we've just at the weekend got sort of like increasing taxes, that seems to be playing out.
Yeah, I think that may flag other issues. I think going on in Europe, we do have deflationary elements continuing in Europe, which will reassert themselves. And the other thing we've not talked about, maybe because as financial people and economists, we know less about politics and more about money, but politics is an issue. We not only have more debt coming out of the financial crisis, more inequality as well, and this whole experience in central banks managing the global economy has created fertile ground for politicians. And I think that may be the hardest thing for us, perhaps, as market practitioners, to understand what the impact of that is.
Yeah, I think they're going to have to be, minimum wages are going to increase, because the politicians, the only way they're going to get into power is that they, the people who have been left behind are, and the people who have been furloughed, the similar sort of guys, then they need their salaries or the minimum wages to increase. Okay, gents, thanks very much for your time. Fantastic insights. Let's see how we get on in 6 months' time, shall we?
Fabulous, gentlemen.
Sounds good. Thanks, Paul. Good to see you.
Cheers, guys. Thanks.
Goodbye.